how long the bear market lasts is tough to sort of stomach for people, but ultimately it goes from the lower left to the upper right. So I'm going to keep owning stocks, and if I'm a long-term investor, I'll take some lumps. If I've harvested some volatility along the way, I'm ahead of the game.
Welcome to The Derivative by RCM Alternatives. Send it.
Hi, this is Brian Stutland, portfolio manager at Equity Armor Investments, here to talk about volatility in the markets on The Derivative.
All right, Brian, how are you?
Great. How you doing, Jeff?
Good. I can't remember if the last one we did, I don't know if you had this background, so I'm going to start asking you some personal questions about your bookshelf here.
Okay.
So STS was your floor badge?
That's correct. Yeah. People nickname me Status on the floor, or Stuts. It's short for Stutland on my nickname. But yeah, that was my badge for many years.
Status. Stuts. I like Stuts better. Then what else you got here? Like a little boys or girls basketball team or something? I can't tell what's happening there.
I got on this side right
Yeah.
there. This spring, Mustang baseball boys. I was coach of the team. My co-coach got me the plaque. We went undefeated and won the House
Yeah.
League championship. It's nothing great, but it's kind of a funny thing to put in the background. It was a good time for all the boys playing. And then next to that, also have the World Trade Center. Obviously, um, you know, sadness around that event, but kind of started trading my own book the day before 9/11, actually, on the
Oh my
trading
God.
floor at the options exchange. So kind of a weird, crazy day as it was, but especially for me to like try and start off as a new trader and then not know what the heck was going on, and then the markets were closed. So kind of keep that in the back of my memory as a
Yeah.
beginning
Things
point.
can always get crazy in a hurry.
Yeah. Uh-huh.
I gotta hold on real quick. Gonna, as long as we're talking eighth grade boys, right? What
Right.
this was the what was this, 22? So what was my son? I think they might have been eighth grade. Yeah. Eighth grade boys, fall ball champs.
Yeah, it's always look, it's as we saw with the World Series this last weekend, it is so hard to win a championship. Like
It's
even when you
crazy.
have it right there for you sitting there, it's never easy to be the best. So, whether it's fall ball or Mustang House League or whatever, it's still hard to win whatever you're doing. So be proud of
The
it, right?
the fun part of that one for us, it was all like his buddies from the eighth grade, and then they in Chicago, you usually leave your eighth grade school and go to a different high school, and so
Uh-huh.
it was like the last hurrah of those guys together, which was fun to
Yeah.
go out
Um,
on top.
yeah.
All right, that's it. The rest are just boring family, lovely family pictures. I'm sure you just got those out of the frame. Those aren't real. That's not your real family.
Right, exactly.
Those were
That's,
the
yeah,
people in the frame when you bought it.
yeah, had to find some good looking people to put in there.
Love it. So thanks for coming on. We were just hanging out down in Nashville at the Talking Hedge event, which was a
That's
good
right.
time. So want to expand on some of that stuff, but and we've done a few podcasts. We've done one with you before. We did one with Joe. So we'll put those in the show notes for kind of background stuff, and you can touch on a little bit as we go, but we won't spend the whole time on background because we've already done that. So anyway, was on a call with an advisor today, and it was an interesting, fortuitous thing as you were about to come on. So he was kind of saying, I'll summarize, was, hey, I don't really hear about the VIX anymore. Is the VIX dead? What's going on with the VIX? Why don't I hear about it anymore? It seems boring now. So that my red flags and alarms were screaming in my head, but wanted
Yeah.
to start there and ask you of like, hey, where's the VIX? Where's it been? What's going on?
Yeah, I mean, there's times when the VIX is boring. I mean, really the natural movement of that kind of product, it's calculating what traders expect implied volatilities to be for the next 30 days in the S&P. And it's like a heartbeat. Like sometimes you're in the resting heartbeat, there's nothing going on and it is boring. And then there's times where, you exercise and the heart rate elevates. It can't stay that way forever. And then it comes back down to the resting level. I think we're kind of in this resting level, but what's really interesting about it, I don't think it's dead, so to speak, because when you look at it, it's kind of trading at somewhat elevated levels, given the like severity of the bull market, right? That we've seen in the last, call it, 2 years since basically the boom of AI and and basically we got past 2022. Um, you would expect the VIX to kind of be like around a 12 or 11 or something like that, given how well the markets behave. And in fact, it seems like the VIX doesn't want to go below 15 or 16. And when traders look at that, to me, that says there's some sort of level of risk in the marketplace. To me, I think it's probably just because valuations have gotten stretched so far on the S&P that there's a little bit of worry. Can it keep going? How far can the market keep going? So I actually think it's a pretty good indicator of what's really going on, and it's very tradable. So I mean, you can forget about it, but I rather trade it as an asset class because there's really some key potential benefits as we talked when we were down in Nashville at the Talking Hedge conference.
Yeah. And then rattle off, you did this down there, rattle off your quick metrics for a VIX of 10 equals blah, blah, blah. You were rattling those off at the conference. That's good stuff for people to know.
Yeah, sure. So like a 16 VIX would represent the market expecting most of the time a 1% daily move in the market over the next 30 days,
So it's
right?
like
Up or down.
inside the bell curve, basically.
Right. Yeah. Yeah. So like, yeah, think of it like a bell curve, or do you ever like on The Price is Right, the Plinko chip
Yeah.
game?
Yeah.
Yeah. So I mean, think of it like drop the Plinko down the middle, and where is it gonna like kind of sort of land, which is mostly like in the middle, right? So most of the time, a 16 VIX is that 1% daily move. Now, the VIX trades a little bit more elevated than expected moves due to some nuances of the skew in the S&P, but think of it that way. So the market's expecting 1% daily moves with the VIX at 16. Basically, if you double it to 32, that would be 2% moves, and so on and so forth, right? So VIX 80 is, call it 5% daily moves like we saw in March of 2020, like at the onset of
Hmm.
COVID pandemic, right? And so you can kind of look at that and say, how are people expecting the S&P 500 to move over the next 30 days? And when it really can't get below 15 or 16, it's not like we're seeing 1% daily moves, right? We're not seeing those 1% daily moves, yet expectations are to see that move. So to me, that says, hey, there's some level of risk. I'm willing to put a little risk premium on my option trade because valuations are stretched or whatnot. And it's just not trading down. Like I said, I would like to see it probably like 11 or 12. That's probably more realistic of the actual realized volatility of the market.
And do you think some of what's going on is we're seeing a little 99 internet boom stuff of spot up, vol up? Like these things are going up so fast that vol's reacting, right? People aren't used to that of
Yeah.
like, how can vol go up when the market's going up? But it
Yeah. I
happens.
mean, yeah, we did. I mean, basically, I kind of like liken it to like 1994 was kind of like the emergence of Netscape. Then you had AOL. I traded in the pit in Netscape when I became a market maker in
Nice. You should have
98,
saved some
2000.
of that paper, have it up on the wall there.
I know, right? Yeah, that's what I should have in the background. Um, but basically, what we saw from 94 and on is the VIX went up when the market went up. And the reason being is I think there's a very high correlation. Well, first of all, volatility in the marketplace. We have a newsletter called the Ripple Effect, and we call it the Ripple Effect because it's like you can't drop a bowling ball in a pool on one corner of the pool and not expect a wave to reach the entire pool at some point. It might be smaller on the other end. But there is this ripple effect, and the ripple effect usually starts in the credit markets and valuations. And so in the
Hmm.
90s, we saw valuations continue to expand like we're seeing now. We saw a revolutionary type technology development in the internet and email and everything else, like we're seeing now with AI. And so those two things coinciding together, I would expect vol to go up, VIX, and the market to go up maybe for the next 4 or 5 years until we reach some precipice of a blow
4 or 5
off.
years?
It could be.
Yeah.
I mean, look at like
Yeah.
94. I mean, if 94 was, let's call it 2023 when OpenAI AI started, right?
Yeah.
We're kind of in year two, maybe 95, 96.
Hmm.
That lasted all the way to 99. I mean, if you look at what the NASDAQ did from 94 to 2000 peak, it was like a 700% return in a major index. So,
That's why people were just jumping over themselves to lever and get in more and more and more.
yeah, yeah. And then along the way, obviously there were some shakeouts, and then 99 we had the Russian debt crisis, so we sort of had like this emergency rate cut decision. We have not seen that yet, which I expect to come at some point. We are seeing the Fed cut rates, They started cutting rates in 2024, just like they started cutting rates in 1994. But rate cuts are right now, they're kind of systematic, right? They're like looking at the data, they're analyzing. We haven't had an emergency rate cut situation. So that's probably coming, and that'll probably create some bubblicious kind of event.
I disagree on that one. I think they're done with the like unannounced emergency stuff, right? Like their lesson learned is like be transparent, um, telegraph what you're going to do way ahead of time. Don't spook people, but
Right.
maybe
Well,
you're
I guess
right.
I
Hopefully,
should say
yeah.
the emergence of like the Russian debt crisis kind of came on fairly quickly. You had
Hmm.
long-term capital management go under. So it's like an emergency event kind of driven, not,
Got it. Yeah,
you're
yeah.
right, maybe not an emergency rate cut like we saw back then, where you had traders basically running back to the trading floor to get on when the Fed announced a surprise quarter point in the middle of their Fed meeting. Like, I don't think we're going to see that. But we are going to probably see some sort of like major carpet shakeout event that freaks.
Why weren't they on the floor during the Fed meeting? They were expecting him to finish the meeting first.
Yeah, I think traders were just like coming back from lunch, Like I was in the pit, Cisco and Oracle were the options trading in there. It was actually the number one rated pit on the Chicago Board Options Exchange at the time.
In terms
And
of volume, you're saying? Yeah.
both volume, and then there were like a rating system by the brokers that would rate like
Oh.
the quality of pits, and we would get rated number one.
Yeah. Who
But
knew?
the
Like,
escalators were right behind us, right? And you could just see guys like running back up the escalator to like dash onto the floor as like the markets roared and came back, and um, fun times, fun times.
what um what do you see that's similar and different between that 99, like when you were there trading those options and today? Like the same sort of froth or not as much? What do you think?
Well, you are seeing the same level of like elevated forward-looking PEs and valuations on companies, right? And if you look at it too, I saw like a published report by JP Morgan that when you see PEs up here in like forward Ps, not just like trailing, but forward-looking Ps, which analysts are, trying to determine how earnings are going to come in. And when they sit in like the low 20s to 25, like the 10-year historical return after that point is not very good. It's rather flat. So you're seeing the same sort of like elevated PE levels that we saw in the 90s. I think the only difference here is that um, AI is like, whether it's OpenAI, Gemini, whatever one of the LLMs are building out, they're building out like a central nervous system in the brain that could be used for robotics, better business productivity, et cetera, down the road. It's like, is there really a valuation to that? Or is that just like, what are people willing to pay to have a central nervous system? Right. And then let's
Yeah.
plop it into robotics. Let's pop it into like our business and AI agents and all that kind of stuff. And then is the secondary level really the next valuation that we have to really analyze? And the first one doesn't really matter. It's just a question of, are they going to get too frothy in their debt and borrowing with each other to play out? So that's maybe the one difference is that we're still kind of in the early. I don't think we're in 99 yet. Put it that way.
Um, you just touched on that, so I'll ask you, any worries with this vendor financing that seems to be happening? Um,
Uh, Yeah, I hear a lot about it because it's like the circle of life, like
yeah.
one guy borrows money to build this one, and this person then is promises to buy whatever, and I'll give you equity. And um, there is some concern that that wheel could stop. But like I said, I think we're still in like the build out phase where that cycle can kind of continue and continue. The question will be really like the second, like the Palantirs of the world, right, that are actually building out practical uses of AI and applications. Right now it's basically like the new version of the CIA Palantir, but the Palantirs of the world, will they start to use this whole ecosystem so that all the borrowing and that circulation actually gets put to use? I
Right.
think that
Or will
happens.
people pay for it? That's the other part.
Right.
Yeah. Love it. So this feeds into, and heard you say before, right? There's actual individual stocks at play here. So you
Yeah.
more than anyone I talk to, a lot of other managers are like, hey, forget all this stock and AI is risky. It could blow up at any minute. You need to hedge. You need to do this and this. But I've heard you a few times be like, no, own that stuff. That's great. Own that over there. Do this over here. So kind of, I don't know if I set that up correctly, but tell us what you kind of how you think about that. Of yeah, there's some great stuff to own out there. Own it.
Yeah. I mean, look, like I, kind of said at the beginning of the show here, right? That the Nasdaq went up 700% over like a 5 or 6 year period, right? So that stuff can really continue to go. And I think, there's a place in the portfolio for it. Now the question is how do you manage that so that it's not the end all be all to your entire portfolio? And so, yeah, the Nvidias of the world are going to be the leaders. Can you just own Nvidia? No, you have to look at AMD. And then I just heard that Cornell University just a week ago came out and validated GSIT, which builds like an APU that takes up a lot less energy, a heck of a lot less energy to do some calculations. So somebody's going to
Hmm.
come along and build a better chip, right? Somebody's going to come along and build a better LLM platform. But do I have to own like this part of the world? Yeah, I think technology, this is a game changer that we're going to see forever. When you get these like, 25, 30-year like revolutionary things that happen, I want to own it. I want to be in it. Now, the question is like what kind of time frame are we in, and how can I continue to diversify my asset allocation? One way we do it, as a portfolio manager, is we buy volatility. So, to the point, I know we've talked about the VIX up, stocks up, but that's where you want to own volatility as an asset class. You want to own some optionality in the market. You want to own some stocks, and sort of put that together as a sort of good mix if that's the right macro environment that we're in. And I think we're in that macro environment.
So expand on that, right? People have been trying to own VIX or talk first about how you can't actually own the VIX. So how do you solve
Yeah.
for that? But then after
Yeah.
that, of like people have been trying to do this for years and years and years without much success because it's a massively declining asset. So tell us how you solve that puzzle.
Yeah, I think on the first part, when you look at owning the VIX, right, you can directly, well, kind of indirectly own it through VIX future contracts. So these are volatility futures contracts. They're traded at the SIBO. You can use options or you can use the futures contract themselves. You can make a directional bet on where you think the VIX is going to be. Now, the nuance to it, unlike most commodity products out there, oil, you buy an oil futures contract, there's embedded storage and transportation costs and sort of like a supply and demand factor as well. VIX and volatility futures, it's just a bet. I'm just going to at time of expiration, we're going to settle our bet up and cash settle it. It's called a cash settle product. We're not delivering, a barrel of oil or a bushel of corn or whatever, right?
Yeah.
So
Zero
while we're
storage,
waiting for,
zero
yeah,
transport. Yeah.
right. So there's zero transport, there's zero carry. So what we're really doing is just where's the VIX going to be, let's say 30 days on expiration from now, right? And that just becomes strictly supply and demand, right? So the VIX future can trade above the VIX for right now, it can trade below it. But on that 30 days, they'll meet each other. But in between, there can be movement above and below the VIX. And so because VIX is sort of mean reverting, it's an insurance product, the demand is usually to overpay for that futures contract. And so there's a little bit of an extra cost, right? If you overpay for the futures contract, if nothing happens at settlement, the futures contract will go back down to VIX and you'll have paid like a little extra than you should have. And so sort of watching that structure on how that trades becomes more of a trader's game than it does. I'm just going to buy volatility futures contracts or a VIX ETN or ETF, which I can own to buy the VIX. The expected return of that is not positive over time, right? It mean reverts with levels of spikes and back down, like that heartbeat that I talked about.
Yeah.
So you want to make sure you harvest that volatility. To your point of how do you trade this, you have to harvest your volatility when those events happen.
And then, but do you guys also harvest throughout? Right? If there's a little bit where you can start to kind of make it more of a neutral carry along the way until
Yeah,
those spikes.
right. Yeah. So what we like to do is, let's say you do get like a small mini spike, then that's a time to sort of, maybe take some profits on the volatility side, sell that out and buy stocks at a lower price and vice versa the other way. The other thing you can do is you can trade it like a long short. You can look at other pieces of the market that maybe have some time decay value to them. I know some traders out there they'll own a structured note at one part of the portfolio, which is almost like an option selling strategy. technique while they own volatility in another, with stocks, right? So you got your notes that are kicking out premium with some defined risk. You've got your stocks, you've got your long volatility position, right? For us, we actually trade S&P options, and like I said, we shift through the VIX futures contracts accordingly to like look at that contango, like I call it, that premium of the volatility futures contract above the VIX itself, and to determine what's the best one to kind of own to mitigate some of the buy and hold decay loss to
Which
own
is the
volatility.
cheapest one, essentially.
Right. So there's times where like when you look at the VIX futures curve, um, for example, February might be at a, call it $1 premium to the VIX index, and November could be at 75 cents, which is
Mm.
expiring, just in a couple weeks, right? So there's only really a quarter point difference between Feb and Nov, but 75 cents between Nov and the VIX now. So, do you want to hold something that's going to lose 75 cents in the next 2 weeks, or do you want to hold something that's going to lose a buck over the next 4 months, right? So we kind of like look at that kind of time decay value, and make an analysis on how to hold VIX futures.
And it's always mostly always elevated above the spot VIX just because nobody knows what's going to happen over the next 30, 60, 90 days, whatever.
Well, you
Like that's
usually
the
find,
uncertainty premium.
yeah, yeah, yeah. That's a good way to put it. It's the uncertainty premium on the market, and so imagine a bull market that's kind of going and going, right? The level of uncertainty, I think, starts to rise. And so you typically see this premium in a bull market, a bull trending upward market, where there's going to be some uncertainty that's going to happen, somewhere down the road or upcoming very soon. Vice versa, if you have an event like COVID pandemic, actually, we saw VIX futures trade at a nasty discount to the VIX itself. Well, you're talking 5, 6, $10 lower than VIX was. Why? Because the volatility event is happening, and now people's expectations in the future are for volatility to subside and come back down to normal.
Like it can't get any worse type of
Right,
um
right. But sometimes that makes for some really good opportunity actually to own those contracts at that moment, even though they are probably going to come down and it's probably going to be a loser. Sometimes you catch those at such a steep discount that those are good to sort of own against, let's say, a long beta position in the market.
and how do you protect or right if you're monetizing along the way to kind of offset that carry, how do you protect against you got out of all your protection and the thing keeps going down? There's a second leg down or a second, third week down or whatever, and you've already monetized everything. Now you're on the wrong side.
Yeah, well, I mean, look, I mean, the VIX, I always tell people it's like a merry-go-round. Like you really never know when it's going to stop sometimes. There are some, indicators and trend followers that have some techniques. Like if they see the VIX making like a lower high and the market making lower lows, right? So stock
Mm.
market still going down, but the VIX is not going up anymore.
Right.
Um, People use that as like, oh wait, there's got somebody selling puts in the market to keep the VIX suppressed because the VIX is calculated off of S&P options. So if option premiums are coming down, there's got to be somebody picking levels on the put side, like saying, hey, the market's going to reach a bottom somewhere. I don't know where it is. It's going to reach a bottom somewhere, and they sell put premium. That brings the VIX down. So that's sort of an indicator of like maybe the market's going to turn. Do I take everything off strategy and volatility? No, because of that merry-go-round effect, right? I might lessen the position. Um, what other traders might do, which is I think a very interesting technique, is so in our fund we're long stocks and long volatility, right? It actually can, that sort of position can act as a really good rebalancer. Jeff, we like kind of talked about like, do you still have to own Nvidia? Well, if volatility is high, our fund maybe is not going to perform as well because you're owning this volatility component that might be coming down even if the market's going down. We're going to continue to own that volatility position, but that might give you a time when volatility is high, trim positions in our trading strategy and buy those Nvidia risky assets at
Mm.
that moment in time. And even if you get hit a little bit, hopefully over time that equation kind of reverses itself.
Yeah, you get the rebalance effect.
Yeah. So kind of it can act as a really good just inherent rebalancer. And I kind of would like history has shown if you stick with that rebalance, it does work. I mean, look, you look at the history of stocks, they go from the lower left on a chart to the upper right over a long period of time. There's just a lot of volatility in between. and it's a question of how big and how long that shakeout is going to last. 99, 2000 was like a 3 year bear market after that, right? 2008 was like a year long bear market. How long the bear market lasts is tough to sort of stomach for people, and so, but ultimately it goes from the lower left to the upper right. So I'm gonna keep owning stocks, and if I'm a long term investor, I'll take some lumps. If I've harvested some volatility along the way, I'm ahead of the game.
What are your thoughts? Do you have, right, you see way more covered call strategies and alternative income that's really just selling calls or selling premium. So all that stuff added up, and I think that's the highest growth AUM mutual fund or ETF category, right? Of like
Yeah,
alternative income, options
yeah,
income.
yeah.
So tons and tons of people selling options. So I don't know if there's a question in there, but just talk about that a little bit of like, what does that do? Does that affect the markets? Is it pushing around the option prices that you guys are looking at? Does it push around the VIX?
I mean, I think it definitely has an effect on the option prices, right? I mean, yeah, the level of growth of option premium selling has been absolutely enormous. Then you couple that with like zero DT options and that trading aspect of it. And so I like the premium that once was on all those trades that made it worth it to sell the option premium. I don't think is quite there on a risk adjusted basis anymore.
Hmm.
It's very easy to tell people, hey, we're going to give you, a yield of 7 to 10% a year or maybe more by selling this option premium overlay. But what they don't tell you is by selling that call on the market, by selling the call, right? A call option is the right to own the market no matter how high it goes. If you're selling that away, you're giving up the upside. And we've just seen like these V-shape moves back up. I mean, it's we're going on 5, 6 years now of
Yeah.
seeing these nasty volatile shakeouts to the downside, and the rip back up is just as nasty and violent and happens so quickly. Um, not to like, I don't like bashing like anybody, so to speak, but just as a case in point example, JP Morgan Hedged Equity Fund, they're only up like 5% this year with the markets up 15, 16% or whatever, because they've just been called away. A lot of
Hmm.
these designed option selling strategies pay for their insurance on the downside by selling away the upside. And that can be a very dangerous trading strategy.
And if you
Uh,
get too big, you have to sell closer and closer and closer to get enough money. Or as the volatility goes down, you have to sell closer and closer to the market.
yeah, it's more of as volatility goes down, you sell closer
Yeah.
and closer to where the market is at, and now you're at more and more risk of being called away to the upside. And if we're in a 1990s like scenario, that's just you're missing, and a possible like slightly inflationary environment. Like you don't want to be called away when there's also inflation, right? You got to at least make money on the stock equity side of things to pay for inflationary costs. So it can be just a nasty strategy where you're just giving up not enough to make enough money.
That's a good thought experiment, right? Like we don't know where we are in that 94 to 2001.
Right.
So if you gave up a half your upside for 8 years to protect against a 60% drawdown,
Yeah.
that's a loser probably, right?
Yeah.
That's
I
def
mean,
someone do the math for me, but that's probably definitely a loser.
yeah. Yeah.
Um, so that's where you guys are coming from. And like, no, I want to participate as much as possible in that upside,
Right.
have as small a drain as possible, and go from there.
Yeah. Exactly. It's like I think when we talked at our conference, I like the word that you used is like we're kind of like your first responders into a situation. Like we want to capture the emergency situation on the downside and protect that. Now there is a cost to it, and we try and mitigate that. But we also the emergency upside move too. We want to participate in that to a degree, so that we can continue to feel the valuation move higher or whatever it is. And so it's kind of like playing the wings to the market.
That's a good, I'm gonna coin a new one. Like for the first responders was a guy at Makita. It's been borrowed by One River and now so I've been borrowing it. But interesting the thing you said there, like you're viewing it more as like I'm not necessarily I am the first responder in the volatility side, but what you really want me is I'm the first one like back in the party. Like the
Right.
boat tipped over, the sharks are in the water. I'm the first one back in the boat
Right.
saying, "Let's go. Let's get this tour back going."
Yeah. Yeah. Right. Yeah. It is. So I guess I'm kind of like your tour guide, and you never want to
Yeah.
kayak a level five a river without knowing where like the rapids are going to catch you, right? So we kind of like get around that and avoid it, and then then we'll catch the fast moving stream back to the upside. Maybe not. I mean, this year our strategies have outperformed the market because the V shape off of April like tariff tantrum has been so sharp. But we won't necessarily always capture all of the upside. We'll still be in the game. We still capture
Yeah.
most of the upside.
But structurally, you're not calling away your upside. So
Correct.
your drag, if any, is going to be from the protection, from like paying over and over again that VIX and not being able to harvest enough to offset that.
Correct. Correct. Yeah.
I like this kayak on the rapids. So some of the guys are getting into the rapids and they just pull their kayaks over to the side and walk the rest of the river.
Right.
Right? Some know
Yeah.
exactly where the rapids are and they can navigate the rapids, and then boom, they're in flat water. And now you're gliding down the river. You're going to get there 10 times faster than the people walking.
Correct. Because they
Yeah.
stepped aside. They got shooken out by everything that happened, and then the river's moving nice and steady but fast down the road, and they're walking. So yeah, I mean and you're actually kind of in some way taking the other side of the trade of all this option premium selling that's going on.
Mm,
And it's such a big market. I think there's opportunity to take the other side and advantage of that. I mean, that's what I did as an option trader, as a market maker. I was taking the opposite side of a trade. And then granted, as a market maker, I was trying to, make my nickel or dime and lay off that risk very quickly, in seconds, minutes, or whatever.
yeah.
But this is someone for taking the opposite side of all that order flow and paper that's gone into option premium selling that's out there.
And what do you think that's a huge like blow up risk for the market and economy overall, all that option selling, or is it just going to be like a people get disenchanted with it because they're only made 5% this year instead of 20%?
I think it's more of like disenchanted with it.
Yeah.
There will be. I mean, we've seen groups blow up from taking like unmitigated, unprotected option selling risk to the
Yeah.
market, whether it's to the upside or downside. Like they've sold.
We'll put the LJM autopsy in the show notes,
Yeah, right.
the famous
Yeah,
one.
yeah. I mean, there's a handful of others over the years, right?
But most
Uh,
of these are covered calls, from my
Correct.
understanding, so you can't really blow up on that.
Correct. That's
Um,
why I'm saying so. Like they're not uncovered; they are covered. They're not, taking endless risk on the market. But so that's why I think it's going to be disenfranchised move. Like, hey, look, I mean, I think this year advisors, especially like, if you were an investment advisor and you were in like some sort of defined risk strategy, and it's only up 5 or 6% this year, and the market's up 15, people are going to be like, what's going
yeah,
on? Why am I
hey.
missing all this?
So let's talk about your equity piece. You're in that fast moving, smoother water. Two programs, right? One is doing more S&P focus, one
Yeah.
NASDAQ focus. So which one do you want to start with? Explain how the equity piece works.
Yeah. So normally as portfolio manager, volatility, it moves so fast. Like the harvesting the crop happens so fast that you only need to own a little bit of it, call it like 10%. The other part is mixed with that 90% of equities. So obviously we know the VIX. Let's just start with the S&P portfolio management. The VIX is calculated off of 30-day options on the S&P 500, right? So it has a very high tied correlation to the S&P 500 itself. So our stock picking wants to correlate to the S&P 500. Now, the beauty of using some stocks and why you don't necessarily need 500 companies or an index is because there can be some tax loss harvesting that you can do along the way, where two stocks behave very similar and they go down together. You can sell out of one, take the tax credit, buy the other, and still ride, back to the upside the same way. Um, that's number one. Number two is to like search for areas that are going to provide tailwinds to the economy. Not all 500 names, like right now, Procter and Gamble. I don't know what that is doing for you right now. right?
Keeping my
Somebody's like,
teeth clean.
yeah, right. Yeah. Yeah. But it's not, there's no tailwind from the economy going on for
Yeah.
Procter and Gamble right now. So you can then choose those like, 40 or 50 names like we do, and sort of structure like we're like a little bit overweight. Obviously, I've talked a lot about AI. I'm a believer in it. So we're a little bit overweight information technology relative to the S&P. We're a little bit overweight utilities because I think there's going to be a huge energy build out that occurs along this way with data centers and everything that's we're already seeing happen.
Yeah. Let me
Um,
check my nuclear stocks. Hold on. Yeah.
yeah, yeah, right.
It's my number one trade.
Yeah, right.
They're getting
It's
hammered today, actually. But hold on, we lost the script. So there's one program is S&P focused, one's NASDAQ focused. So on the S&P side, it's 90-10,
90-10, correct.
and the 90's doing active individual stocks plus
Correct.
index.
Mostly just active individual stocks, right?
Got it. Okay.
Yeah, so that's going to give a high correlation to the S&P, but then when you add the volatility component with it, now you kind of like create a portfolio that's more like a large cap value, low volatility fund, right? Where, we've kind of proven we've never had a month over month down more than 6% since we started in 2019. Um, we've we typically have like half the drawdown to the market. So it's kind of like this 50 beta protection. So it kind of makes like I said, this low volatility strategy when you take S&P with um with our VIX volatility overlay.
Hmm.
Now, versus the NASDAQ side of it, when we take the NASDAQ stocks and we're just going to trade NASDAQ 100, that's what we want to own. That's the growth in the market. When you put like an all growth stock picking behind with the volatility component, now you've actually kind of like almost replicated the S&P,
Hmm.
almost replicated downside risk like the S&P, but upside of like a NASDAQ kind of thing. You're not going to get all of the NASDAQ to the upside, but you're going to get a lot of it. So when we sit that around 85 or 90%. It's like almost adding like a higher beta equity position into the mix for somebody that we tell advisors S&P stock picking with volatility is like a low vol. You almost could use that to replace your low volatility for your moderate conservative. We actually get benchmarked by Morningstar's moderate conservative index.
Which
There.
is the weirdest thing I've heard. I thought you were trying to get a like a voter block or something, moderate conservatives, but
Yeah.
that's an actual index. What's in
Yeah.
there?
It's just like your balanced fund blended thing, like a
Like a
Merrill Edge.
Procter and Gamble. It's like a
Well, no, it's
it's
balanced
fund
between like
managers.
fixed income, like a full balanced fund approach, right?
Okay.
Like mix of fixed income, equities, whatever blend,
Got it.
um,
Okay.
that like your moderate conservative investor would want to be in.
Moderate
Um,
conservative.
yeah, and then your Nasdaq with our hedge is going to be more for somebody that wants to take some risk in the market, right? Like you're more growthy kind of individual, but kind of feels like, hey, the market's a little frothy. I don't know if I want to keep going with this thing. I want to add some protection to it. Then Nasdaq with volatility is a good one to own.
And that makes it look more like the S&P, you're saying.
Correct. Correct.
But just in terms of volatility, the downside should be much less, right?
It can, but because you have that higher beta, sometimes the vol component's not going to hedge out as much as like,
Hmm.
the other fund, right? So in 2022, like, we were down, I think 18, 19% on the year, but 2023, when the markets were back up, we were up like 36%. So it's going to behave more like an S&P kind of thing, um, and put a hedge. Now, the thing that was interesting about 2022 is that um, the second half of the year, actually the market went down and VIX went down, right?
Yeah.
That's the one area of risk where volatility is not occurring. Realized volatility is not occurring. It's just kind of like a slow grind down. But
Where you want
yes,
a second responder. Yeah.
right, right. Um, but like the tariff tantrum in April or whatever, then Nasdaq with volatility is very good because volatility spiked very hard very quickly, and it did cut drawdowns, right? So that
Yeah.
would be the goal. Is like if we get a very nasty downside shakeout, hopefully Nasdaq with VIX gives you less drawdown than the S&P.
And there's some basis risk there, like the VIX isn't completely covering the Nasdaq. Do you guys
Correct.
measure that? What's that look like? What's that basis?
No, I mean it's a very good point, right? Because, like I said, the VIX is calculated off of S&P options, and S&P options are calculated and anticipated off of the S&P index. So there could be this like disjoint thing that happens where the Nasdaq is moving not correlated to the S&P or not having some
Hmm.
sort of beta to it. Typically, we see about a 1.2 to 1.3 beta of Nasdaq to the S&P. But like you said, there could be that basis point risk where it doesn't line up. Like 2022, the Nasdaq was down, I think, like 33% with the S&P down 18. So it was a lot
Yeah.
worse than 1.2 beta. And that's some of the risk in sort of putting Nasdaq with volatility and VIX. Some of the risk to do that, but we,
There's no such thing as the NASDAQ VIX.
you know what, there was an attempt to create
Yeah.
VIX futures trading. There was Vol Q index, which was calculated off of like at the money Nasdaq options, and then they listed volatility futures contracts on Vol Q, and they really didn't find the right liquidity. People didn't really love the way of the calculation of it,
Hmm.
and so it really never took off. So there's not a good long volatility match for the Nasdaq, and so like our design here is like let's
Maybe
get
we
the
should
next
roll
best.
it back out, right? Seems like a needed product with everyone long all these tech stocks.
Well, it might be coming soon to a theater near you. I'm not gonna. Yeah,
Breaking news here on the
yeah,
derivative.
yeah. It kind of.
Tell us more.
I can't talk too much because we're working on a few things here to figure something out.
I
But
love it.
that you're right. That probably a better proxy kind of uh contract with the Nasdaq, given what 60% of the market cap now is like Nasdaq stocks in the S&P, I believe. So
Well, that was going to be my next question. Like, this seems like that basis risk is becoming less and less and less because
yeah,
of that fact of like the S&P's littered, maybe it's the wrong word, or bejeweled with tech stocks,
yeah,
versus 5, 10, 15, 20 years ago. Not the
yeah,
case.
yeah. I mean, still like I think information technology sits at like 30%,
Hmm.
35% in the S&P. So it's not like it's not even a majority still yet, but obviously these market cap companies are having an effect. And I mean, just look at the earnings last week, right? From the Mag 7, we saw Amazon, we saw Microsoft come out, we saw Google come out, like Meta, all these things were moving the volatility last week, on these like seven names, right?
Yeah. What's your thoughts? My take is that all this AI is massively deflationary, and right, you're going to have these uh, people coming out of college making 100 to 300 grand at Google or whatever. Um, those jobs go away, and then what does that do downstream to the economy? So I think you're like this AI boom is putting itself out of business eventually, right? Like you're so. What are your thoughts on that? Who knows?
Oh man, I mean, I could probably have another hour-long podcast
Yeah,
discussion on this, but I mean, yes, I think the risk to it that I don't think is in the market right now, to be honest with you, is this. You're right, this massive deflationary effect that this can all have, because ultimately, if AI is taking jobs and making or just kind of shifting things and making things more efficient, then there's less money that to go around to people, right? And then
yeah.
that just kind of brings things down. I mean,
To buy
honestly, I
the
think
products that the companies are using the AI to sell, right? So it's like this
right.
circular weirdness, and everyone would be like, "Well, the buggy companies, like everything pivots in the economy." But I'm like, this feels different. Maybe I'm just old and thinking that, but feels different this time, which are
No,
dangerous words, you know. Yeah.
I don't think so. I mean, I tell people like I think the day is coming, not tomorrow, but the day is coming where we're just, sheep herding around in the field and, you want to go eat some grass somewhere, go do that, but there's nothing really else going on besides doing that. um,
Wait, what do
uh,
you mean by that? Like that the AI is just taken over and we don't have anything to do?
yeah,
Yeah.
yeah. I mean,
In a good way though.
that's the bet.
It's like Star Trek, like there's no money, everything's fixed and taken care of. I don't know if you're a Star Trek fan, but yeah.
Yeah, no, I am.
Yeah.
And I mean that's the sci-fi world of it. Like you just live in this bubble and you're protective and taken care of, but there's really nothing for I mean, look, if you want to go play a game of baseball, like we could recreate
Yeah,
a fall ball league of our own and not have to worry about it, right?
exactly. Yeah.
um so yeah, it's look, the rise of the machines is the point is to make businesses more efficient. We are still in the very early innings of that. I mean, I think you look at it, Apple iPhone that actually put a reasonable device in your hand to communicate with others, like going back to 94 to 2007, right? The iPhone that took 13
iPhone came
years.
out in '07.
Yeah. Yeah.
Hmm.
So that took 13 years to happen. I think there's probably that same, 10 to 15 year window from 2023 on where you have something really usable and marketable and happening all the time. And then that thing is going to grow for the next 10 years after that. Um, so, we're still, call it 10 to 20 years away from like this major massive deflationary effect, but there is going to be more and more of it. I mean, look, when I went to the trading floor, right, I started in 98. The floor was open outcry. You had a quote reporter taking your orders. You wrote things on paper. You shouted buy and sell. And, by 2003, there were a lot of jobs not there anymore, right? A lot of
Yeah.
people out of work and had to go find something else to do.
And by now, none of those jobs. I mean, still in the
Right.
options, but in the futures, no.
Yeah, and the financial markets are the leading insight on what's going to happen. It,
Hmm.
it usually happens first. I mean, I had a touch screen in 2001 when I started right before 9/11. I had a
Whoa.
touch screen
Where
to put
people are
my
like, what is that?
yeah, like it was very common on the floor, so it seemed normal there. But if I told somebody else about it, they'd be like, "Oh, that's the future," whatever. I mean, we didn't see the iPad for years after that. So it does give a little insight of what could happen if the trading floor is any indicator of like rise of the machines and what happens, then yeah, there's gonna be a lot of people out of jobs. It worries me.
And then my other medium hot take is why are I'm seeing all these chat GPTs running ads. I'm like, if you're already starting to run ads on like how to make pasta for your girlfriend, that doesn't seem like a good sign to me. It seems like we're topping to me based on my unscientific ad indicator.
Is that gonna be the new the Malec ad indicator?
Yeah, the Malec ad indicator. But like what, right? If you're just making money hand over fist and there's more demand than you can handle, why are you already running ads? And it's probably
Um,
because it's like there's going to be a winner take all maybe, and everyone's trying to get the most users to be that winner.
Yeah, like I said, I think right now, like the initial build out, OpenAI and everything else, it's the central nervous system to, I think, ultimately robotics, which is going to happen later
Mm.
on down the road, like very sophisticated robotics, like acting like a human being kind of robotics, whether that's a chip that goes in our brain or it's an actual robot doing the work. Um,
I'm
and
ready for
so
the chip. I got to wear this Whoop band all the time. Like just put something in my arm. But then how do I charge it? That's the problem.
your own body's energy, right?
Yeah. Well, yeah. But I cut you off. Sorry. I don't
Um,
remember.
No, so when it comes to like this efficiency and what's going to happen, it's going to take time to develop, and I think like I said, like OpenAI is building out the central nervous system. What that is worth, I think, is many times more multiples than what the market's willing to give it, to be
Right.
honest.
And you think there's multiple central nervous systems, or can that work, or does it need to be a winner take all?
Oh, I
That's
mean, if
who
you're
knows.
into like the world of Zen, there can be multiple, right? It can be
Yeah.
multiple upon multiple. Um, Building it. Now there will probably be a handful of just winners outright, but there can be more than one winner to it. Especially, I mean, that's capitalism, right?
Yeah.
Even if we have this massive deflationary, like you're saying, and if that were to happen, there would still be capitalism taking
There'd be
place.
one huge winner. Yeah.
Yeah.
With like great, the 10,000 shareholders of that huge winner are richer than their wildest dreams, and the rest of us are in depression. But to your point, that's why I got to own that stuff. Let's finish. I think you mentioned this down on your panel down there. Hot take or like what you see in the volatility space. Like, I think you said no one's ever seen or what could be bad is if it stays elevated for some weird period of time. Was that you?
Yeah, I think what could be interesting. Well, two dynamics I think, on a hot take. Number one, if you look at the move index, which is the volatility index on bonds,
Hmm.
it's trading at yearly, multi-year lows right now. So there's very little movement in price movement in the bond market. And I talked about the ripple effect.
After
Um,
being somewhat crazy in like 22 and right coming off of COVID, wasn't
right.
move was pretty crazy.
Yeah. And now it's come all the way back down. So there's little volatility going on with bond markets, right? There's, the Fed saying maybe there might be one more rate cut, but don't put all your bets on it. So if we're sort of like in this known static interest rate environment, how is there volatility somewhere else? Well, there can be volatility somewhere else because when you have like this liquidity in the bond market, people can flush money into the system,
Mm.
raise valuations to a degree where it's like, well, this is maybe too, I'm not going to get return on my investment. And then you have this like, higher runaway volatility effect in the equity market. And then all of a sudden the credit markets crumble after that. Like normally it's the credit markets that crumble first. This could be the opposite, where the equity market volatility gets so expansive that pushes the ripple effect. Maybe you drop the bowling ball. The bowling ball is going to drop in the deep end of the pool instead of the shallow end this time.
Mm.
So I would just be cognizant of that because, like I said, that's where you can get runaway upside move on the market and then a nasty flush out.
Is that I think of that like a whack-a-mole, right? Like, oh, the bond volatility is low. It's like getting artificially suppressed somehow. So where something else is going to pop up, right?
Right. Yeah.
While you're trying to hold, oh, well, cover that, cover that. Nope,
Yeah.
something's going to pop. Which
Yeah.
it seems
Well,
like gold was the thing that has popped over the last 2 years, but
yeah. Well, I mean, gold has made a tremendous, massive run. I think a lot of it, there was obviously a big shift of governments buying gold versus like the U.S. dollar, in the last few years. But some of that is rightfully justified given the level of government debt that we're taking on. I mean, we didn't even talk about, which could be a whole nother podcast, is the government shutdown. I mean, it's like the government shutdown, nobody even cares. I don't hear anybody
yeah.
talking about it, and our debt is just
That line killed at the conference. You were like, "Hey, oh, by the way, the government shut down. Does anyone here in here even care?" And there was
yeah.
nobody raised their hand, nobody said a thing. You're like, "It's
No,
so
yeah,
weird. This isn't even a thing."
I know, right? But the government debt is an issue, and I think that has a lot of tie to gold and that moving significantly higher in the last couple of years. Um, and so maybe as you push this like bond volatility down like the whack-a-mole, what's going to pop up? Is it government debt? Is it valuations in the stock market? It's going to move. It's going to move to somewhere. So you know, watch where that is, and that's why I like owning volatility with stocks right now because that could be the next vol movement.
And then what's a weird vol scenario that could unfold, right? Like 22 is kind of our last weird vol period.
Yeah,
Market down, vol meh. So like
yeah,
what would be a weird vol thing that you could foresee that is trouble for some people? Maybe not necessarily you, but for some.
yeah. Well, I mean, it's like we kind of just said, is like market up, vol up. Like normally, like 75% of the time, I think that's the stat. Really, is that the VIX moves opposite of the S&P.
Hmm.
Historically, the percent, the VIX goes up 4%. Vice versa the other way because VIX can't go to zero, otherwise nothing would be trading, right? There'd be no volatility. So at some point the VIX levels off. So on a 1% up move in the market in the S&P, VIX historically goes down like 2 or 2.5%. Because eventually it stops going down. And in fact, when that kind of correlation is, this is what I'm talking about, is VIX has been down, sitting here in the teens, we could see market move up and VIX actually go up. Opposite of what happened in the back half of 2022. So that's a scenario to sort of look that could be weird that plays out.
What are your thoughts? It seems every VIX spike has become shorter and shorter and shorter. Does that keep going? Do we just get like hour-long VIX spikes, or is that somehow need to end eventually?
I think we're kind of I don't really see it getting shorter, let's say in the last year. I see your point, like, from I think what happens is you have this big vol event like we saw in 2020, where that elevated volatility lasted for quite a number of months, right?
Yeah.
Obviously, the pandemic drove that. Following that, what typically happens is a period of like these shorter spikes, like just micro burst spikes that people freak out. Um, then back to like, VIX is mean reverting. Like we will have this longer, expansive volatility spike. Um, we're kind of like slowly turning the table on that. If you look at the level of put buying, the skew in the S&P, like what people are paying for a put premium versus a call premium of like the same
Yeah.
moneyness. Um, we're not seeing like we're seeing a little bit more elevation in the put buying right now. So
Hmm.
than you saw a year ago versus when you see a rally and vol comes off. So maybe that prolonged vol expansion thing is is getting ready to happen, but sometimes that takes a little bit for to work out. We had a major volatility event in 2020, and sometimes like now we're getting tighter volatility events. I expect a bigger, longer, drawn out volatility event to happen. Maybe that happens a year or two from now.
And let's finish. We were talking the double three-peat Jordan Bulls down
Yeah,
there. So equating it to portfolio theory, we did a blog post about it. We'll put in the show notes. But who's the volatility protector piece on that Bulls team? I didn't prep you for that. Sorry, but who's
yeah.
your
Um, well, what's interesting is, you almost could say Harper was, right? Like he was kind of like you didn't need him to score a lot. He played the point guard. He was a big, tall point guard. He could defend. I mean, people don't. I mean, obviously Pippen, great defensive player. Rodman, great defensive player. Jordan, great defensive, all around, obviously defensive player. But Harper really like his length and size to sort of lock down the small guard, and his ability to do that was like very key and instrumental to like sort of um, you know, stopping like the sort of streaks on the scoring side of things. So
Mm.
slowing down the other team's offense.
Right?
Um,
If another team going on a run is the equivalent of the market selling off, right? He was the hey, put that on that guy and stop this in its tracks.
yeah, yeah. Or at least like slow down the initial part of the other team's offense. The guy bringing the ball up. Let's slow it down. Let's make it difficult for him to make a pass. Let's make it difficult for him to hit a three when the ball's like rotating around. Um, and so he kind of helped give stability to the whole team. And so, that's what the VIX and volatility is. By owning that as an asset class, you're giving stability to the portfolio.
Love it. And I actually in the blog post, I our friend Mike Philbrick was equating this to these new alt portfolios and was saying Kerr, like he was leaving Ron Harper out of it. Ron Harper started. Kerr came off the bench actually,
Yeah,
right? I
right.
think Kerr came off the bench and Kukoc came off the bench. Harper
Yeah.
was the guy. Um,
Um, yeah, I
and
mean you can
then
almost say like that six man, like it's like the overlay, right? The extra guy like to help protect, so there could be some cases for that too.
and then tell your story about seeing Jordan's winning shot.
Oh yeah, I mean this was super fun. So I used to be a seat vendor for the Cubs and White Sox. Well, really, you joined local 236, I think.
A
Yeah, I think
seed bender?
seat.
Seed. I thought you
Yeah,
said seed, like you were what?
yeah,
Yeah.
no. So selling beer and hot dogs to people. So
Nice.
you would join a union, and they would automatically then get you employed to each local stadium, right? So you could technically you could work at the Wrigley Field. You could work where the White Sox
Oh,
played. You
that's
could
why sometimes recognize same guys. I'm like, hey, I remember you from the Bulls
yeah,
game.
yeah.
Okay,
It's
because they're part of the union.
Yeah,
Makes
it's all the
sense.
same union, right?
Chicago.
Yeah, and we know how the unions in Chicago work, right?
Yeah. You're not slinging one dog until you sign up for this union.
Yeah, right. Um, like I even got to do like the World Cup in '94 when it was in Chicago at Soldier Field. I
Oh,
worked at
fun.
that one because the union employed you at Soldier Field, and I would do like the Bears like first couple preseason games before going back to college
Hmm.
for the semester.
What
So
was your
anyway,
call?
what's that?
What was your call? Beer here, dog here.
Hey, beer here. Hey, hot
Nice.
dog. Um, so you kind of before the game would start, like you'd arrive about an hour and a half before any event, and because you're a part of a union, of course, it's all seniority on who gets to sell what, right? Back then, obviously, Budweiser was like the best like beer sale thing, right? So
Yeah.
you had to be 21 to sell beer, and then that was the hottest thing. So the guys that had the most seniority got to sell Budweiser. Anyway, so you'd line up outside the stadium at some point. You'd get your assignment on what product you're going to sell and what part of the stadium you're going to sell it to.
So like the kid selling the claw at the Cubs game, the like foam bear cub claw. He's last
Yeah,
on the seniority list.
yeah, right.
Yeah.
Or cotton candy was probably kind of down the low low
Yeah.
because that only catered to like a specific person in the crowd. Um, so you'd line up outside the door, you'd get your assignment, you'd go into the stadium through that door. There would be security there, check, make sure you had your badge on and everything, and then you'd go in. So me and my buddy, we obviously working through all the stadiums, we talked to other vendors. We knew where in the Bull Stadium, what door all the vendors would kind of like line up to get their assignment and go in. And we're like, this was game 6, the first time the Bulls beat the Jazz. And we're like, you know what? Let's go put our vending like uniform on, even though it was like, the apron or whatever that you had to wear. We brought our union card, even though it was
Yeah.
slightly different uniform for the Bulls. And we're like, we're gonna walk up, pretend like we're working and vending that game, and then we're gonna go watch the game instead.
And this
So
is of the finals versus Karl Malone in Utah, game 7, game 6.
I think it was
They
game
won in
6.
6. Yeah,
They
yeah.
won in 6, I think, that first year, right? On
Yeah.
the almost last second shot by Kerr. So um, I tell my buddy, and this is before obviously cell phones. I'm like, all right, you go in first. At this door, there's like a staircase that went up. I'm like, take the staircase up to the top. Whatever you get to the top level, open the door and go in there, and I will meet you there. Before cell phones, just like, okay, he goes in. I don't know if I'm going to find him or not or whatever. I just got to hope he's there.
And then you were going to go in 5 minutes later or whatever.
Yeah.
Yeah.
Let him take all the risk first, right? So he goes in, 3 to 5 minutes pass by. I'm like, he hasn't come out. So he's either arrested or he's in. So I'm like, all right, I'm going in. I go in, I look confident. I walk past like the security guys, show them my union card. I go up the stairwell. I take it all the way to the top, open the door. Cliff, there you are. What's going on? We're in. Yeah. Turns out that game, Kerr hits the game-winning shot. They win it. Who was it? Pippen or Kukoc makes the steal on the inbounds. Bulls win the championship. We got in. I mean, we were, college kids just wanted to see a game, right?
Awesome.
I would do that now.
Yeah.
But silly college kids doing that.
But although I'll say a number of full-grown adults with high-paying jobs that I know that like basically snuck into World Series game back in 16
yeah,
for the Cubs was unbelievable. Really? They were just like, oh, if you go in near this gate and they have the like metal detectors that are, those new style metal detectors where you just kind of pass through them, and then people are mulling around and there's no longer a turnstile, right? They're like scanning your ticket.
Right, yeah,
Basically, it was bedlam, and they just kind of mull around in there until the person turn their head and they do a back
quick
step
dash
and
through.
Boom, yeah. But like literally, like 5 to 7 people I know did that. It's like what?
That's awesome. I guess that's
when
I think 9 years to the day when they had the parade for the Cubs, and almost an identical World Series this weekend to what the Cubs were, except the Blue Jays couldn't come back in the extra innings to pull it off after blowing the lead. It's I guess if that one maybe is worth going.
That might be our new metaphor. Your programs are Ohtani, right? You can hit home runs and then you get out there and play defense and shut the other team down when you need it, when it's needed.
There you go.
All in one player.
Right? Yeah, that's right.
Love it. All right, Brian. Great talking to you. We'll see you soon.
Okay, Jeff. Thanks for having me on here. Look forward to talking soon.
All right. Take care.
Yeah. Bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.